Hello traders, such topic as smart money is gaining popularity. So little is known about the mechanics of the strategy, and it's so important not just to trade the template but understand the logic of price movement. So what does smart money mean? In which the order blocks and so-called smart zones that are gaining popularity appear? Let's find out. Smart money is a style of trading based on price movements caused by huge players, not the crowd. The modern crypto market is such that if you participate in the movement created by the crowd, you are not protected against the manipulation of a huge player, and you always risk falling into his trap. Therefore, trading with the crowd is always a riskier option than trading with a big player. Yes, of course, you can trade at the breakouts with the crowd and even make quite good money from it, but a trader should always have a backup strategy in his arsenal for the hardest time when the crowd is regularly manipulated and not allowed to earn. The crowd that is in fact retail will always have less chance of a stable profit, rather than the large participants who manipulate retail. Let's figure out how to find the entry points of smart money strategy. Let's imagine we have a huge player with a capital of $100 million. The core problem of the huge player is that in order to load huge position, he needs quite long period of time inside the consolidation to let the participants gradually execute his multiple limit orders placed inside this consolidation. It's a very long way of accumulation of his position before the breakout, before the main movement. However, there is another way for a huge player to load efficiently and quickly. A huge player always understands that the crowd or scalpers consider the multiple touches to the level as attractive place to catch the impulse. There is no problem for a huge whale to push the price, and it doesn't matter to which side, long or short. More important to have enough time to load and fix position than properly, because huge player really affects the market even when fixing, due to huge amount of his positions. So let's imagine he uses 1/10 of his huge capital, or 10 million, just 10 million. He opens a long position before the breakout, just to show everyone, hey traders, hey guys, the breakout has started. Before this, he placed a lot of small limit orders here for sale. Many small limit orders on the way of potential breakout. Then he releases a huge long position by the market, or it's usually several huge prints by the market, just to show the participants that the breakout is coming, and the market reacts instantly. So he just provokes scalpers to rush into the breakout. Huge number of small players open a long position with very huge leverages. What does it mean? We have very huge demand here in this specific point that executes the supply of huge player in form of these limit orders. He just creates artificially this situation just to execute his supply or to load his short position in very short period of time. So finally the breakout goes well. In this point, most participants start fixing. We still have here one position opened on $10 million. Then he adds by the market even more short positions here, because this is the edge of the breakout where the scalpers fix their long positions. The critical point of fixations appeared, and this creates the dumping power. It helps huge player to reverse the price with very small efforts. The first long position is still opened, and it already in this point, starting from this point, brings a loss. The price falls down, and this area is called order block. or false breakout of the level. A small trap created by a huge player to load his position in a very short period of time. Then the price goes down and huge player starts fixing in these parts. He fixes very gradually, not to make price roll back immediately, because in this case he fails to fix all the position in profit. As soon as he fixes, the price reflects on it, and as he is making fixations that impact the purchases, he fixes his profit and simultaneously pushing the price towards the first entry point here. All the time, this position was his loss, unfixed loss. That's a kind of hedging. Then he fixes finally his last position of the short one that brings him a huge profit. And even more here in this point, he fixes the very first position, this position of 10 millions that he used to make this trap, the long position. So again, he finally fixed the last part of his short position and fixed the first long position here in break even. And that's it. Fixing the long position here, this position in 0, he sells it, the huge amount, 10 millions sales in this point. The price reacts on it by falling from this point. That's the entry point for us. In the middle of the order block, this is our profit. It works on all the time frames because the market is fractal. We place stop loss behind this zone and take a pullback from this area. And there is quite obvious example of such situation. Here we have quite obvious level. Here we have the liquidity graph that in fact it's an order block. And from the middle or the edge of this order block, we take a pullback with a stop loss here. I think it's clear. If you want to find out more in details how to trade such strategies with higher accuracy, please write it in the comments below. Follow your risk management and stay in profit. The video was prepared by the CScalp Trading Terminal team.